I'm regularly asked by new investors what mutual funds and exchange-traded funds are, how they differ, and which ones they should invest in. These are great questions, and it's important for you as an investor to understand the answer so you can make more confident and informed investment decisions. So let's get into it. Hi, I'm Lachlan Campbell, the founder of Mad Success. One thing I've discovered over my 30-year career is that a key to a happier, wealthier, more fulfilled life with a lot less stress and anxiety is better money management. The purpose of Mad Success is to empower you to achieve your dreams without the constant worry about money. How do we do that? By providing resources and coaching to help you design an exciting vision and plan for your life, and to grow your confidence and knowledge with money and investing to ensure you fulfill your life plan. Your dreams and goals should be a central focus in your life to be truly fulfilled, but too often money gets in the way, leading to financial stress, worry, and a mindset of money scarcity that creates doubts about your ability to achieve your dreams and goals. Am I right? But money is just a tool. Its purpose is to underpin and support your ability to achieve your dreams. Better money management means developing healthy money habits, growing a positive relationship with money, and learning how to invest confidently. Our mission is to empower you to live focused on your goals and dreams, because money is just a tool, and you can learn how to manage it in support of your dreams. When you're starting out as an investor and looking to build your wealth for the long term and to achieve your financial life goals, investment funds should be the primary way you invest your money. So it's really important to learn which type of investment funds make the most sense for you. Let's keep building on your investment knowledge by defining what an investment fund actually is. Mutual funds, exchange-traded funds, or what is known as ETFs, index funds, and unit investment trusts are some of the different types of investment funds. That's the generic term for all of them, investment funds. An investment fund starts with a pool of investor money, or what is also referred to as investor capital. Capital, in this case, is just a fancy word for your money as a fund investor. But as you learn the languages of investing, know that capital is the money available for investment. The investment funds we want to invest our money or capital with are large liquid funds with billions, if not tens of billions of US dollars in size. The word liquid means the fund can be easily sold and quickly converted back to cash, usually within the same day. An illiquid fund, or an illiquid investment in general, would be one that you cannot receive your cash back quickly. An illiquid investment fund might require a minimum 1 week's notice that you intend to sell the investment. Or in some cases, the notice period to receive your money back could be anything from 1 month to several years. That is illiquid. As new investors, we're okay with some illiquidity, like a day or two, but generally not weeks or months, unless you know the money you have invested is truly long-term money and you won't need it for at least, say, 5 years or longer, and you don't mind it being locked in for longer. So you wouldn't want to lock in emergency fund money into an illiquid investment that takes weeks or months to sell, such as with real estate, for example. ETFs trade daily on the stock market, and liquid ETFs can be sold immediately during stock market trading hours. Mutual funds and unit investment trusts typically can be sold the same day at the end of the day with a specific cutoff time for same-day purchase or sales. If you miss the cutoff, your purchase or sale would be transacted on the next business day. Some mutual funds and unit investment trusts may require 1 week or 1 month's notice to sell. This information is provided in the fund's prospectus. The prospectus is the document that tells you everything about the details of the fund, including its goals and objectives, liquidity, trading schedule, and any other fund restrictions or rules. Each fund has specific investment objectives or goals. These objectives or goals are fixed at the launch of the fund and cannot be changed. A goal could be a targeted annual rate of investment return, say 6% per year. A goal could be to mirror and track the performance of a stock market index, such as the S&P 500 index, which is the goal of index funds. The investment fund's goal could be to outperform the index, not just matching the index. For example, stating the return of the fund will beat the S&P 500 index by a minimum of 2% annually. There are many different examples of investment goals for the thousands of different funds available, which can be very confusing for new investors. An investment fund invests in and holds a collection of individual diversified investments pooled together into a single combined portfolio, or what we call the fund. Each fund is divided into a certain number of units or shares, which can be purchased by you, the investor, similar to buying the shares of a company. Each unit or share trades for a single price, which is the fund's price. This price moves up and down depending on the total performance of the underlying investments, whether that's stocks, bonds, real estate investments, etc. The underlying investments or assets of the fund depend on the investment objectives or goals of the fund. Again, the Fund Prospectus will tell you what types of investments the fund can hold and if there are any restrictions on those holdings. For example, a fund may be restricted to only hold stocks. Another fund may be allowed to hold both stocks and bonds. Some funds have other restrictions. For example, an S&P 500 index fund can only hold companies that are defined as part of the S&P 500 index. That fund cannot buy stocks of any other companies. Another fund may be allowed to invest in other funds, which we call a fund of funds. There are many, many different types of funds holding different types and characteristics of stocks, bonds, real estate, foreign currencies, commodities, and so on. As an individual investor in the fund, you have no say how the money is invested. You choose the investment goal of the fund that suits your investment objectives and your own level of investment risk. If you're a new investor and concerned about losing your money on your investments, broad-based index funds like a world equity fund or large stock market fund like an S&P 500 index fund are some of the most liquid and least risky fund objectives because they have the widest diversification of underlying investments in the fund. Diversification spreads investment risk across the many different types of investments held in the fund. For example, an S&P 500 index fund invests in the top 500 largest companies on the US stock market, spread across 69 different industries. With that many different companies and industries, if any industry is in decline or any companies are underperforming, these negatives are offset by industries that are advancing and companies that are having great results. Diversification spreads the risk of investment loss, often reducing the volatility of the fund, meaning the highs and lows the fund's price could fluctuate. A more diversified fund should have less volatility in price. A fund is also a professionally structured portfolio that creates investment efficiencies for you, the investor. Using our example, the S&P 500 index fund has 500 stocks in the fund. You could try to set up your own portfolio buying a piece of each of the 500 companies, but that would prove not to be a very practical thing to do. So it's much easier just to buy the fund. Investment funds can be active or passively managed. Actively managed funds are managed by an investment manager whose entire job is to maximize the performance and profit of the fund and minimize losses. Or the fund can be passive, where the fund's investments match and follow a predetermined market index, also known as an index fund, without an investment manager buying and selling and trading in the fund. So what's an exchange-traded fund? Well, just as the name implies, an exchange-traded fund is a fund that you can buy and sell on a stock exchange. That's why they're called exchange-traded, because they're traded on the stock exchange during stock exchange trading hours. Say that 3 times fast. Exchange-traded funds are the easiest investment funds to buy and sell because they're the most highly liquid and easily traded from any online brokerage account, just like a stock. You can start buying ETFs immediately after you've opened your online brokerage account, which, if you have not yet done so, please see my video, How to Get Started Investing. The link is here and in the description below. Once you've opened your online brokerage account and placed money in your account, you can buy ETFs during stock trading hours on the stock exchange where they're listed. For example, if you're buying an exchange-traded fund like the Vanguard index-linked S&P 500 index ETF, stock symbol VOO, which trades on the New York Stock Exchange in the US, then you can only invest in this ETF when the US stock market is open. Stock exchanges do not trade 24/7 like cryptocurrency markets. They are most typically open 5 days per week, usually Monday to Friday. And trading hours do vary by exchange, so make sure you look online when the exchanges are open so you know when to invest. The New York Stock Exchange trades Monday to Friday from 9:30 a.m. to 4 p.m. with no break for lunch, which some exchanges do. ETFs have revolutionized investment fund investing because of their ease of access and very low fees. Most ETFs are passive, meaning there is no investment manager actively managing the fund. So they will typically track an index or stated basket of underlying investments. The companies that launch the ETF will oversee their product and ensure it is operating smoothly for your benefit. There are actively managed ETFs, but the majority of ETFs are passive index-linked fund designed to help you track the market and profit as the underlying investments profit. ETFs can be very specialized, and as previously mentioned, the more specialized the fund, the fewer the investments in the fund, meaning lower diversification, meaning higher risk to you, the investor, and likely more volatility, meaning larger swings in price. But not always. But this is a good rule of thumb. The more specialized the fund, the higher the risk. ETFs are very easy to buy and sell, as I've mentioned. They are highly liquid investments, and this is both an advantage and a disadvantage. An advantage because they have made fund investing very low cost and easily accessible. And the ease of trading means when you need the money as part of savings goals, you can quite readily access your money. But the ease of trading means individual investors often trade them like single stocks, selling when the market begins to sell off and hoping they can time the market and avoid the downside sell-off risk. It is proven that this strategy does not work. Emotional investing is a recipe for disaster. If you're not a professional investor, trying to time the market will likely mean you'll lose more money than you make. That's a statistical fact for most investors. It's always better to buy and hold for the long term and buy the funds you're in regularly and consistently month after month for the long term. That's wise long-term investing. Okay, on to mutual funds and unit investment trusts. These two types of funds have different legal structures, but you can invest in them in a very similar way. They both have diversified portfolios and both are required to distribute capital gains and dividends to their shareholders on a regular basis. Unit investment trusts are less common these days. They differ from mutual funds in that they have an expiration date, meaning the trust at some point in the future will sell all of the underlying investments and return your money to you with the corresponding gain or loss accumulated over time. As well, unit investment trusts are passive investments, more like ETFs. The underlying investments are bought at the beginning of the trust launch and then are held passively throughout the life of the trust. Trust units, once initially purchased, can be sold and can be traded between existing unit holders. Mutual funds are far more common, so for the purpose of this video, I will focus on mutual funds. In 1924 in the United States, the Massachusetts Investor Trust Fund was launched. It was considered the first mutual fund in the industry. Mutual funds are typically actively managed by an investment manager whose entire job is to maximize the performance of the fund and not lose money. That said, there are some index-linked mutual funds, which are passive funds, similar to the passive index-linked ETFs. Again, these are known as index funds. Because mutual funds are mostly actively managed, you have to pay for the privilege of having a professional investment manager managing the investments of the fund. And that typically means higher fees than ETFs. Mutual fund fees can run as high as 5% per year, but because of the advent of low-cost ETFs, mutual fund fees or their expense ratios have come down significantly in recent years to make them more competitive. The investment manager is responsible for deciding which underlying investments to hold in line with the fund's investment goals and objectives, how much money to put into each investment, meaning the percentage allocation of capital to each investment, and when the investments should be bought and sold to benefit the fund. Many mutual funds have ETF counterparts, which are essentially the same fund, but the ETF version costs less and trades daily on the exchange. If you're investing your money for 3 years or longer, I recommend you buy mutual funds so you don't touch your money, because they are a little harder to sell compared to ETFs. Mutual funds, when you buy and sell and place your orders, they're executed once per day, and all investors receive the same price. Because of this format, they're less liquid than ETFs. ETFs are easily bought and sold through your online brokerage account during market trading hours, as I've mentioned. A word of caution. Because of the ease by which ETFs can be traded, if you are not a disciplined investor, your emotions could get in the way during a market sell-off, and you may be more tempted to trade out of an ETF rather than hold for the long term. Mutual funds are more set it and forget it, which makes them safer for long-term capital growth and protect you from your emotional self because they're not as easy to sell. My pension portfolio, for example, is made up of about 8 different mutual funds. I look at them once a year and make a decision if any need to be removed or consolidated, but that's it. Otherwise, I don't touch them. I just let them do what they're supposed to do, and that is to grow my long-term wealth. If you buy ETFs and are invested for the long term, consider not having the online broker app on your phone so you aren't tempted to watch the daily performance of your underlying investments. I know as a new investor this can be tempting, but I strongly recommend you don't keep the app on your phone. Watching daily stock market moves can impact your emotions and push you to sell when markets are selling off, or to take profit when markets rise suddenly, rather than just trusting the long-term investment process and only checking in every 6 to 12 months to ensure your long-term plan remains on track. You're investing in investment funds to be able to sleep at night and have a long-term investment plan in order to achieve your goals and dreams. Start investing with liquid index-linked investment funds, mutual funds, or ETFs. Passive funds track the index. Active funds try to outperform the index. Historically, most active managers do not beat the index consistently. So I believe you're better off investing in a passive index fund, or a few of them, which will also have a lot lower annual fees. Start by investing in large global or broad market index funds. Do your research. Try a platform like etfdb.com. We'll put it down below. The ETF database, as it has lots of different types of ETFs to research and discover. Or go to any of the largest mutual fund providers like Vanguard and Fidelity. I used to work at a company called Schroders. They have tons of different funds. I have no bias to which ones you look at. There's many out there and they're excellent. There are about 2,000 passive ETFs in the market, about 700 active ETFs, meaning ETFs managed by an investment manager. They do exist. And around 7,000 actively managed mutual funds, as reported in December 2021 by Morningstar Direct, an investment funds research company. If you're still unsure what to do, send me an email, ask@madsuccess.com, or ask your questions in the comments below. If you got value from this video, please hit that like button, subscribe to the channel, and please share the Mad Success channel with your family and friends who could benefit from it. I'm Lachlan Campbell, and this is Mad Success. Cheers.